Good morning. It's May 2nd, and my name is Ray Schoonover. I am with S2O Capital Management. We are registered investment advisors in the state of Texas. Hey, I wanted to go over what makes us different and why investors should care. Certainly, talking about the idea that we're wealth managers, it's not like there's not enough of us, right? And so, and generally, our target, in terms of communicating our message is going to be to try to get across what our, I think, unique selling and value proposition is to investors who probably already have an advisor. As one who's been in the business for a good amount of time, since 1983, I can tell you that most, and if you just look around, most of what passes for market advice today is a market opinion. And how are you supposed to know? And we prefer to concentrate a little bit more on what we can know to try to help us with what we can't know. Because after all, what we're looking for here is a favorable future outcome. But it's hard to be consistent if you're just relying on market opinions that are looking to buy low and sell high. The good news is we can improve your portfolio's probability for a favorable future outcome with the power of two. And auction markets are a little different from virtually everything else. They give us two ways to generate profits off of the same asset. So, when we're looking at the idea of how to be a successful investor, Will Rogers puts it out there. Don't gamble. Just take all your savings, buy some good stock, and hold it till it goes up. And if it doesn't go up, just don't buy it. We see the irony, I hope, in that quotation, but that's also the irony in operating under a directional-only approach. Because long-term directional investments are going to allow long-term uncertain outcomes. And when we look at, frankly, some really good stocks, this is a cross-section of stocks. This is over 5 years. GE, probably no secret, hasn't done well. Range Resources, an oil company here in Fort Worth, did well for a period of time, gave most of it up. International Business Machines, IBM, 5 years, down. Ralph Lauren, similarly. So time, which is conventional wisdom's approach to risk management and diversification, but time in this particular case is what we're talking about, is not always an assurance that we're going to have the success that we might want to see. And in those cases where we've invested not only capital but 5 or 10 years or more, if we're not being paid for the risks that we take, we may be wasting more than just capital, but something even more important, which is time. And so this is one of my favorite movie quotes. It's actually from one of my favorite movies, and it is a quote within there. And even though it's a comedy and a fictional movie, I thought this quote was kind of true. It says, "Look, we've got no way of knowing what lays ahead of us in the future. All we can do is use the information at hand to make the best decision possible." The elephant in the room here, in terms of conventional advisors and maybe even your current advisor, if they're a directional only or if they sell product or these kinds of things, it could be a clue that they are not using all of the information at hand as best they otherwise could. Because if you did, you would recognize something, and there are certain inalienable truths that are out there. Stocks don't always go up, they don't always go down. Of course, when we're directionally oriented, the time that they're not going our favor is the time where we're backing up instead of going forward. But the truth is they always go up and down. And so if there was a way to generate profits from your portfolio, no matter whether stocks are going up or down, then that might be a good strategy to input in with your other directional long-term growth plans and investments to increase your probability for success. And that's exactly what we do. We share with you that there are two ways to profit. beyond buying low, selling high, or if you're inclined selling high and buying low, but beyond those directional ways, if you buy a stock at 25 and you might notice that from 25 up certainly is a profit, but if it goes below your entry price, you stand to lose. And so we want to try to increase our probabilities of success of profit and avoid that of loss. And the way we do that is by noting that there is another way for us to generate a profit. While we hold our underlying investment asset at a cost of, say, 25 in this example, we can actually sell a range of potential outcomes. In other words, we might go in and we might say sell the 35 or 40 calls and generate a premium for that, or we might go in and sell the 20 or 15 puts and generate a premium for doing that. And therefore, as long as it stays within the range, we are generating a profit, which, by the way, can serve to reduce our basis, and doing that over and over again over time is a great way to increase the probability of your overall portfolio success. So, to be clear, our way to produce a profit is to own real assets for our clients while selling wasting assets and thereby generate a higher probability of success. The good news for me is this makes things more certain because math is involved. Besides looking at charts to try to predict a future direction of a stock, we can look at the volatility, which happens to tend to regress towards means and to sometimes get low and sometimes get high, but typically stay within kind of a median area. This allows us to, instead of trying to predict a favorable outcome, react to volatility spikes in order to take the opportunity there that, say, being passive would never give us. So we're using math and technology to determine your probabilities of success. Technology today has advanced to the point to where if we're looking at the blue shape to the right, it's going to paint for us a picture of what the market's predicting a range of potential subset outcomes to be. Outside of that range would happen about 32% of the time. That would be about approximately 16% to the upside and 16% of the downside, but 68% of the time within that range. And so that gives us the ability to put strategies in place that allow us to have this second engine of profit apart from just being directional and passive. So we sell volatility. That's what we do. And if we think of it, it's having these two ways to profit is not unlike how we might invest in real estate. If we were to own a building, think of it this way. Your model for profit here more than likely employs two ways to achieve investment success. You would not just buy a building, would you, and hold it for 10 years just looking for capital appreciation to be able to sell it at a higher price, being passive along the way? No. More than likely what you would do is rent out the space so that you could generate cash flow from the rental income minus your cost of operation gives you a net cash flow. Well, we can do the same thing, and we want to do, I would think, the same thing with every opportunity that we can for spikes in volatility around our core holdings to generate cash flow from the selling of out-of-the-money call option premiums. These are wasting assets. Time generally inures to our benefit in a short-term way, and it is a magnificent way to generate additional net cash flow or a second engine of profitability for your portfolio. let's look at the real benefits of such a plan. If you're looking at, say, 10 years on a $100,000 investment at 8%, you're going to generate $215,892. If we can generate an additional 4% with our second engine of profit, we're going to have 12% over that same 10 years. That will give us $310,585. That is an additional $94,000 in income over and above a passive type of circumstance. Sorry about that arrow thing. This technology is something I'm working on. So the net effect is that we can diversify more than just asset class for a properly diversified portfolio. We can diversify, and many investors should be looking at strategic diversification in addition to asset diversification. So we think there's a smarter way. We think the smarter way is to generate as many side hustles as you can against your assets that you own. Any way that asset can bring you additional income, cash flow, profits is a way to increase the probability of your investment success. More people, I think, need to be talking about how the auction markets benefit us in this way, because there are so many investments that we might look at that only allow us one way. So be smart. Understand the domain that is the auction market or the stock market. We are S2O Capital Management. We'd love to talk to you about the benefits of the way we do business. And so I would encourage you, if you have any questions at all, to give us a call, and we would love to hear from you. Thank you.